In today's video, we'll discuss the common errors retail traders should steer clear of when analyzing charts. But before we move forward, don't forget to press the like button, and if you're new to the channel, subscribe and enable the notification bell so you won't miss our future uploads. I'll catch you right after the intro and disclaimer. So let's begin with point number 1. Always pay attention to candle momentum and size. This is a 5-minute time frame chart of Nifty 50 where the price declines after facing resistance at the previous day's high, but then rises again, breaking this resistance level with a bullish momentum candle and moving upward. After hovering near this candle's high for some time and giving retail traders an entry opportunity for a long position, the price quickly drops, causing losses for all retail traders here. But the question is, despite such bullish price action in the market, why did the price fall so sharply? If you understand how to read the chart, the answer to this lies within the chart itself. Let's uncover it. This particular day, the market opened with a gap down compared to the previous session, which forced all the buyers holding long positions from yesterday out of the market. They're out, meaning there's still a small amount of liquidity available on the lower side, but the sellers who entered at higher levels yesterday are still present. Because of the gap down open, they are in profit and therefore continue to hold their positions here. This indicates that today the highest liquidity from retail traders is sitting at higher levels rather than lower ones. So the price quickly moves upward, breaks the previous day's high, and keeps rising, forcing all those sellers out of the market. Now, since the market already trapped the sellers once, after this bullish momentum candle, more buyers who missed entries below begin opening long positions in line with the breakout. However, because of the psychological resistance level of 25,500 on the chart overhead, very few buyers choose to enter here. On the other hand, sellers step in with the belief that the market will not break this level today and will remain trading below it. From a price action perspective, the close of any bullish candle here is the strongest signal, yet the last red bearish candle has failed to form above the wick, and the candle sizes are now shrinking compared to the ones below. Almost all these candles also show long upper wicks, which signals that sellers entering here are consistently pushing the price lower. This reduces buying pressure, and with selling pressure increasing, the price drops sharply, sweeping the liquidity of buyers positioned in the lower zones of the chart. So whenever the price starts forming small candles on the chart like this while approaching a strong psychological level during an uptrend, it indicates that momentum has weakened due to the declining interest of buyers at that point. If the candle body keeps getting smaller near a level and the upper wick consistently exceeds the body, it signals that buyers are trying to push prices higher but repeatedly fail to secure closes at elevated levels. This places sellers in a stronger position than buyers. Such candles are called rejection candles in price action, and they act as early warnings of potential reversals in the market. That is why if these candles appear on the chart at higher levels, one should avoid initiating a long trade there. In this chart, the market has formed multiple rejection candles after the red candle. This reflects that sellers still dominate here, while buyers keep lifting the price upward, placing their stop losses below. Due to the increase in liquidity around this zone, operators create the illusion of a breakout through these green inducement candles, attracting even more buyers. But as soon as the premiums rise because of a spike in option prices, the market reverses sharply with strong selling pressure as those positions are unloaded at higher levels. Now, in this chart, we've analyzed using only 3 concepts: rejection candles from our price action series, inducement from the smart money concept series, and retail trader liquidity. Yet many retail traders keep learning new strategies daily, but when it comes to trading live, they freeze. Constantly trying new things leaves them confused, unable to focus on a single method, and so they keep entering and exiting trades randomly without proper analysis. This emotional trading leads them into repeated losses. So, if you agree with me, you must take trading seriously. Keep it as simple as possible and design trades using only a few reliable techniques. Because your goal in the market is to earn profits, not to learn everything and author a book about it. Focus only on methods that align with your trading style and refine them by practicing on charts as much as possible. Let's continue now. Number 2. Always look back. This is the 5-minute time frame chart of Nifty 50 where, after trading above the key psychological level of 25,500. The price moves down and keeps consolidating between 25,500 and 25,400 throughout the session. Because of this, sellers holding short positions from higher levels are unable to secure strong profits, leaving some of them still in their trades since no bullish price action appeared on the chart until the day's close. This strengthens their confidence in the bearish trend, expecting the next day to open gap up and continue the prior downward momentum, which again attracts fresh sellers to build short positions here. Now, observing the price action so far, it looks as if the market will head straight down after triggering the stop losses of buyers positioned at lower levels, as sellers appear dominant. But what often goes unnoticed is the size and distribution of liquidity generated here through the stop losses of both buyers and sellers. Operators continuously display bearish price action on the chart, drawing your focus in that direction, which leads many retail traders to adopt a bearish outlook and plan trades accordingly. However, if you look closely, the market already provided opportunities for sellers to initiate short positions at 3 distinct levels on this chart, and only near this level did a handful of buyers enter for long trades. Because of their small number, the price didn't witness any major rally and closed around this zone. Now, analyzing the quantity of stop-loss liquidity from retail buyers versus sellers, you'll notice that seller-side liquidity is greater. This means if the market continues downward from this point, the operators won't have enough buyer volume to execute their large selling orders. On the other hand, there is still heavy liquidity from retail sellers at higher levels. So, operators craft a bearish-looking move that triggers option premiums, then sell at higher prices, sweep the liquidity overhead, and drive the market upward. To avoid falling into such a trap, you must recognize on which side of the chart retail trader liquidity is greater and on which side it is lesser. Because market price always shifts from balance to imbalance and then from imbalance back to balance. Therefore, along with the chart pattern forming on the screen, when planning a trade entry, carefully observe the side where retail traders are most likely positioning themselves. Chart patterns only show you the precise point or level for entering a trade, allowing you to aim for higher profits with minimal risk. But to determine the correct direction of the trade, you must study the chart closely and detect the imbalance forming in retail trader liquidity. Only then can you identify fake moves and protect yourself from getting trapped by chart patterns. Now, let's move on to the next mistake. Number 3. Always identify premium and discount zones on a chart. This is the 5-minute time frame chart of Nifty 50, where the price rallied upward from the bottom in a strong bullish move, forming large green candles and multiple fair value gaps across the chart. Fair value gaps, also called FVG, represent imbalance during price movement, and whenever price returns to these gaps in the future, the likelihood of a bounce is high. But to determine from which area the reversal is more probable, you must mark the premium and discount zones on the chart. For this, apply the Fibonacci tool from the swing low to the swing high. Now, the zone from 0.50 upward is referred to as the premium zone, while the area below is the discount zone. In a bullish market trend, operators generally prefer selling in the premium zone, while buyers look to enter in the discount zone. In this chart, one FVG lies in the discount zone, and 2 others are positioned in the premium zone above. That's why, if we aim for a long side entry, our attention should be on the fair value gap created in the discount zone below, since the chances of a reversal here are higher. Soon after, the price declines with strong bearish candles, fully filling the FVG located in this discount zone, sweeping liquidity in the process, and then moves upward again. Therefore, for reversal trades in a bullish trend, you can utilize the discount and premium zones effectively. That's it, traders. Thanks for watching this video. I hope you gained real value from this video. If you did, make sure to hit that like button. It truly supports the channel and shows us you're enjoying the content. And if you're new here, don't forget to subscribe for more trading strategies. Thanks for watching, stay disciplined, stay consistent, and I'll catch you in the next episode.